Welcome, my name is Sasha Moore and I'm here with Andrew McVeigh, who's the managing partner of the investment management business Ramara. Welcome, Andrew.
Thanks for having me.
So Andrew, I'd like to just unpack a little bit the whole notion of a private credit income fund, because it is, I believe, a bit of a niche environment. And it's more of a newer style of investment in that it's quite unique. So could you provide a bit of an overview of that?
Yeah, certainly. And I think one of the key things is private credit and income-based funds off the back of that are probably not unique as a vehicle, but our approach to them is really unique. And that approach is really one where, again, we're looking at diversifying the underlying credit exposures. A lot of competing funds and a lot of competing managers have single asset risk. So it might be a single type of asset, or it might be a handful of larger assets, but they're all within the same verticals, such as real estate or mortgage-backed securities or something like that. What we're really trying to do is have the diversity in the product set and the diversity of the underlying loans and underlying credit that really provides that income stream and also really limits the risk and concentration of risk in underlying loans, which ultimately means that we can blend a larger pool of loans, smaller dollar values, and the risk of systemic loss and capital loss for overall investors is limited as a result of that.
Okay, and in terms of then this structure, how is investor appetite travelling for this type of a model?
Look, it's a unique model on the basis of the underlying loan risk. And I think once we've been able to explain that and have that conversation and show investors how we originate and essentially how we can package up these loans and the diversification that they actually receive, there is tremendous acceptance of that. I think the challenge is, as I said, a lot of people are very aware of the single asset or single type of asset exposures, and that's something that we've seen, particularly with the raising interest rates, have struggled to attract and probably struggled to retain capital that was already allocated to them, whereas we're now starting to see that capital flow into our fund. And the reason for that is we've got diversity of underlying credit. So in certain circumstances, we will have real estate exposure, but we'll mix that with SME exposure, residential exposure, some consumer exposure, and we'll actually be across the credit spectrum. So where a lot of people are having concerns around the real estate market at the moment and the credit offerings around the real estate market, we're able to offer them a pool that has some real estate exposure as well as a whole bunch of SME exposure, and most of that is all underwritten via bank statements, but it's all structured and it's all secured. So we don't do any unsecured lending, which is something that, again, given this current environment and given the market, has fallen out of favour quite substantially with the raise in RBA rates.
Okay, great. Thank you for your time.
Thanks.